Good afternoon, ladies and gentlemen, and welcome to the Induction Healthcare Group PLC half-year results for the 6-month ended 30th of September 2021 investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted any time using the Q&A tab on the right-hand corner of your screen. Just please simply type in your question and press send. The company may not be in a position to answer every question it receives today. However, the company review all questions submitted and publish responses where it's appropriate to do so. These will be available via your Investor Meet company and will notify you by email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll, and if you would give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand over to Guy Mitchell, CFO, and James Balmain, CEO from Induction Healthcare. Good afternoon.
Brilliant. Thank you, Mark, and good afternoon, everybody. I'd like to start by thanking all of you for taking the time to attend our interim results presentation. We're going to be covering the 6-month period ending the 30th of September this year. We're really excited to share the details on what's been a transformational period for the company. And on that note, I'm going to hand over to Guy, our CFO, and he's going to run you through the interim highlights. And then I'll take back control and go through some of the strategy for the company moving forwards. We're going to turn the camera off now to make more space for the presentation, but we'll come back on camera for the Q&A at the end. So just down at the bottom right one, that's it.
Okay.
Go forward one that's it, on the slide.
Perfect. Okay, thanks, James, and hello to everyone who has joined. James, we're delighted today to be announcing our interim results. James has already mentioned it, but it has been a transformational 6 months for the business, and probably the biggest period of change for the business since the IPO itself. In June of this year, we completed the £25 million fundraise, and on the back of that, we did the successful acquisition and integration of Australia-based Attend Anywhere. Purchase price was £25 million. The purchase price itself was satisfied by £16 million of cash and £9 million of shares. On the back of this acquisition, we've seen a big jump in revenue and ARR. If you remember our last full year to 31 March 2021, we were a 1.5 million revenue and 1.8 million ARR company. And today we've now posted revenues of 4.6 million for the 6-month period, with ARR running at over 14 million. This has also had a significant positive impact on profitability. And while we're still loss-making operationally as we continue to invest for future growth, the losses have significantly reduced compared to prior periods. We also continue to keep a strong eye on cost control, being as efficient as possible with the working capital available to us, and are well capitalised at the end of the period. As you can see, we've got 12.8 million of cash sitting on the balance sheet at 30th September. In addition, in the periods, our first major non-healthcare contract was signed, and this has real potential to allow us into other markets, and we're really excited about this one, and we'll learn more about this later on. But above all, with all the above noted factors, we're delighted to be announcing today that we expect to surpass the existing market expectations on full year adjusted EBITDA, and we're expecting to reach a break-even position at the 31st of March 2022, and this is reflected in the paper put out today by our brokers N+1 Signers. And with that, I'll hand back to James.
Thank you. Do you want to go forward one slide?
I will do.
Thank you. So I'm going to begin with a bit of a whistle-stop tour of our 4 applications at Induction, which I hope will be relevant for those people who are new to the company and our story. So I'm going to begin on the left-hand side with the largest revenue generator that we have, which is Attend Anywhere, which, as Guy just told you, we acquired earlier on this year. Now, Attend Anywhere is a video consultation platform, and I really want to land the point that that's different from video conferencing. So platforms like Teams or Zoom are video conferencing platforms, whereas Attend Anywhere is a healthcare-specific video consultation platform. And that real focus on healthcare and that real focus on consultations is one of the reasons why the platform has such a dominant position across the British Isles today. Now, historically, it has been a one-to-one consultation platform with full waiting area support. Recently, we launched healthcare-specific group consultations, which was a hotly requested feature, and we're already seeing really exciting usage levels on that. And during the first half of next year, we're going to be launching full telephone support as well, because we acknowledge there are still a lot of clinical professionals who like to run remote consultations over the phone. Thinking about the next application, Zesty. It's a patient portal. Think of that as a digital platform for patients visiting hospital. We've seen tremendous growth in patient registrations, particularly during the pandemic. We're at close to 400,000 registered patients now, growing at nearly 30,000 patients a month. And we expect to break the million patient registered mark, the million registered patient mark, in the summer next year. And finally, we've got a number of really important partnerships, and I particularly want to call out the partnership we have with Cerner and also the partnership we have with System C. Now, both of those companies provide electronic patient record software for hospitals, and between the two of them, they account for roughly half of the English hospital market. So those partnerships are very important for Induction, not only for Zesty, but for other products. Now, on the right-hand side of the diagram, you'll see our two native apps, Android and iOS apps, that are used by very large numbers of clinical professionals, both in the English NHS market and further afield globally. Guidance is a decision support and guideline management app for clinicians. It allows them to store digital copies of clinical guidance inside the app. And a good example of that would be prescribing guidelines for antibiotics. We have around 230,000 clinical users on the guidance platform, and we're seeing increased week-on-week, month-on-month engagement and usage with that platform. And finally, Switch, which was the first company we acquired and we IPO'd with, is a staff directory and messaging platform. We see very high usage. We estimate we're now touching the sides with nearly 100% usage within the English secondary care market, that's hospitals. And it allows staff to bypass switchboard and communicate with one another directly. Finally, if you look at the bottom of the diagram, you can see our HealthStream platform. Now, that's a data integration platform. It's proprietary to Induction, and it allows our four main applications to communicate electronically with existing hospital systems. And we're compatible with Apple's Health Records on iPhone service. We launched that in the UK as a partner with Apple and Cerner last year. We're directly compatible also with Cerner, System C, DXC's Lorenzo product, and more recently, the community care product Rio from Serverleg. Now, that ability to integrate with underlying systems is a key USP for Induction and something that differentiates our products from competing products in the marketplace. Go forward one. Now, I think it's helpful. I'm going to run around this slide clockwise. And what I want to talk about here for each of the four applications is how much revenue they're generating, what's the market share, where are we going to see growth coming from? And in particular, I want to spend a bit of time talking about renewals of the Attend Anywhere platform within the NHS England market, which is a very a key focus for us as a business. So thinking about the annual recurring revenue for Attend Anywhere, I'm going to start there first. The total current contracted ARR for Attend Anywhere is around £12.8 million. Now that breaks down as 7.6 million in England, 2.2 million for Scotland, and interestingly, that's two contracts. That's a health contract with NHS Scotland and a local government contract. Combined, they're worth 2.2 million. We then have 1.6 million with NHS Wales. Now that was renewed in the summer last year, and we saw a £400,000 uplift in the value. So the previous value was 1.2, and we renewed at 1.6 million. Our sales partner Involve, who manages our Republic of Ireland contract and some smaller contracts with private hospitals in the English market on the Consult UK platform, generates around 1 million in ARR, 900,000 a year. And then finally, as we've very recently announced, we've just signed a contract with the Department of Work and Pensions for Attend Anywhere, and the minimum contractually guaranteed value for that is around 500,000 a year. And Guy, in a couple of slides' time, will take you through the details of the potential revenue we might be seeing out of that contract over the next 2 years. Now, thinking about how the Attend Anywhere revenue breaks down, obviously that 7.6 million is the lion's share, not only of Attend Anywhere, of our Attend Anywhere revenue, but also of group revenues as a whole. So, and the vast majority of those contracts are one-year contracts that expire in March next year. So key focus for the business has been working on those renewals. Now we're at a point now where we don't have complete visibility. We're still halfway through the contracting cycle. We will update the market as we get more information in the run up to March. But I'm pleased to say that it's going incredibly well at the moment. We're very confident that we're going to retain the vast majority of the English contracts. We will see a degree of downward price pressure. Now, partly that's due to lower usage now that we're out of the COVID pandemic, but I think also one of the downward price pressure drivers is our desire to push out the contract term. So we're working really hard with all of the regional contracting bodies in NHS England to achieve at least a 2-year term when we renew. And obviously we're negotiating slight discounts to achieve that longer term. And as a business, we're really interested in increasing the total contract value in the contract term. And we're quite happy to sacrifice small percentages of near-term revenue to achieve that. In terms of market share for Attend Anywhere, now this is based on usage. So at the moment, Attend Anywhere is contracted with 232 of the 233 trusts in the country. But when we think about actual usage, and I'm talking about proper usage where the platform's used sort of week in, week out, we see usage of in 163 trusts for Attend Anywhere. So it's got a really high market share. Now, the data that we have on things like Teams and AccuRx, this isn't really in the public domain and it's only based on our internal estimates. So it comes with a bit of a health warning, but we think that Teams is used in around 34 trusts, AccuRx is used in around 9, and then there's a couple of other platforms that are used in 1 or 2 hospitals to make up that 5. And the key thing to understand here is that even though these numbers relate to the 233 in total, we definitely know there are some of the 163 hospitals that are also using Teams, etc. And then finally, when we think about growth for Attend Anywhere, there are a number of areas where we think we can grow, footprint and revenue for the platform. We're really excited about non-health public sector. We see the Department of Work and Pensions contract as the first, we hope, in a number of other government departments that are seeking to virtualize their services when they engage with citizens. So we're very excited about growth in that area. We're very excited about the formation of integrated care systems. Our strategy as a business is an integrated, flexible care platform that brings our 4 applications together, underpinned by our integration engine, HealthStream. And I'm going to talk on the next slide around how we see the value there, that we think Attend Anywhere is a key component part in securing upsell revenue off the back of its existing contracted footprint. We think there's an interesting opportunity in social care, and we're going to be exploring that, care homes next year. And finally, we're very focused on generating revenue for the whole business for our flexible care platform internationally in territories beyond the British Isles. So hopefully that gives you a bit of a steer on Attend Anywhere. I'm going to move over to Zesty. It's currently generating around £1 million a year in ARR. We've had a challenging 18-month period with Zesty where it's been difficult to get the attention of hospitals during the pandemic. We're seeing a real reversal with that now, and we're really bullish about Zesty's growth prospects coming into FY23. In terms of market share, we're currently working with around 15 hospitals. Dr. Doctor, who's our main competitor, we think have around 19 hospitals. And then Healthcare Communications, they have a number of products, but their most comparable product to Zesty, i.e. a portal product, we think is in around 8 hospitals. And I'll just reinforce the fact that these are based on our internal estimates. This data isn't sort of in the public domain or verified. And then finally, when we think about growth, the combination of Attend Anywhere and Zesty is really key to our growing our top line revenue in FY23. I'm going to talk about the opportunity that we have with integrated care systems on the next slide. I'm going to move up and talk about guidance now. Currently, it's generating around 700,000 a year in ARR. We have around half the hospitals in England using that product, but then we have a further 118 hospitals using it in territories around the world. We're fairly confident we're going to see a 15 to 20% organic year-on-year growth from this platform as we sign new hospitals both domestically and overseas, and as we upsell new features on the platform to those customers. But we're also really excited about the role that guidance can play inside our flexible care platform. We're just exiting now some really meaningful pilots where the guidance application that has been traditionally used by clinicians is now being used by patients. And patients are receiving digitized leaflets that tell them how to manage their care, as opposed to getting those leaflets on paper. They're now getting them inside the guidance app. And we think it's a really interesting opportunity to roll that guidance functionality into our integrated flexible care platform. And then finally, Switch, our communications product, hugely widely used, must be one of the most used clinical apps across the English NHS. Currently generates very little revenue, around 50,000 a year. Again, it's been a challenging time to try and monetize Switch during the pandemic, but we're feeling much more confident about our ability as a business to monetize Switch properly coming into FY23. And we think there's a really big opportunity. It's heavily used at every hospital in the country. We think we can achieve between 5,000 and 10,000 a year in ARR for that platform, and we can attain a very significant market share given its usage and its underlying lack of competition. So we go next. Now, thinking about our strategy coming into FY23 and how as a business we're going to grow from the outstanding revenue growth we've seen largely inorganically this year. We're forecasting quite strong revenue growth organically next year prior to any other acquisitions we might choose to make. And a key part of that revenue generation is going to be the upsell from the existing Attend Anywhere contracts to the full flexible care platform that includes Guidance and Zesty. Now, there are 42 integrated care systems in England, and Attend Anywhere is currently contracted with all 42 ICSs. And the average value per ICS is £180,000 a year. So these numbers are all annually recurring revenue. Now, we know from the limited number of procurements that have already happened that ICSs are likely to be paying around £700,000 a year for an integrated flexible care platform that offers digital services to all of their patients in their region. And we know that the value there is going to be around £700,000 a year, and that's based on 2 or 3 procurements that have happened already. So if you think about the value we're currently achieving versus the opportunity ARR, the difference, the incremental revenue we can generate is just over 500,000 a year. And if you then imagine that we won all 42 ICSs, we'd end up with just over 20 million in addressable market ARR within the NHS England landscape. And thinking about drivers to, why do we feel confident that we're going to do well in this market? Well, firstly, I talked about partnerships, and those are really, really important. We're very well placed when we go and we talk to ICSs when we're partnered with the underlying EPR that powers the hospitals in those regions. Secondly, we're seeing large amounts of national funding being made available for technology specifically aimed at reducing waiting lists. And there are 3 key things that they're looking to procure at an ICS level. The first is remote consultations, and for us, that's Attend Anywhere. The second is the ability to capture data remotely from patients using forms, and that's our Form Builder product, which sits within our Zesty product range. And finally, it's giving patients the ability to manage their own outpatient appointments, and which is seen as absolutely key. There's a big initiative across the NHS right now to deliver patient-led booking at scale in an attempt to achieve far greater slot utilization inside secondary care. And again, that's our Zesty product. So we think we're really well positioned in this ICS space with those 3 things the market are looking for with our existing products that are already well known and already being used at scale. And I'll hand back to Guy, who will now go into the numbers.
Sure, thanks, James. Just very quickly to touch on the financial review for the period. To go back to the £25 million fundraise that we had, we raised 25 million of equity in June there, and this was used to facilitate the AA acquisition, Attend Anywhere acquisition, and also provided working capital to fund the integration and also to facilitate further organic growth within the group. AA itself as a business, when its last full year of trading, had 10 million of revenue and 4 million of EBITDA. Integration is going well, and it's going better than where we expected it to be just now, and we're beginning to realise some of the efficiencies that we thought we would over the period. These efficiencies are coming operationally, but also in other areas as well. Attend Anywhere is currently based in Australia and paying tax at an Australian tax rate. So there's things that we're looking at as a business as we get the group into a structure that's we're looking forward and for future growth. There'll be other benefits, efficiencies fall out of this as well as we look to do this. So the mix of the AA acquisition and solid organic growth, we've got ARR expansion of over 900% year on year. We were at 1.4 million of ARR in September 2020. We're now at 14.4 million of ARR. And revenue growth on the back of that as well, 700% year on year from September 2020, where we had £500,000 of revenue. We're now at 4.6 million. Of the 4.6 million revenue, Attend Anywhere contributed 3.6 million of that revenue. But also we've seen year-on-year growth in induction guidance of almost 20% to 320,000, and induction Zesty has has doubled year on year to just over 600k. This had an effect on our adjusted EBITDA loss, or as we're terming it, our adjusted EBITDA, which is now 0.7 million compared with 2.4 million last September, and indeed 4.8 million adjusted EBITDA loss for the full year FY21, which is 31 March 2021. Cash balance at the end of the period, as we mentioned already, is 12.8 million. We're well capitalised, and really this is due to efficiency on costs, overall good governance, and again, we're expecting to be ahead of market guidance on just full year adjusted EBITDA, and we're also expecting to be ahead of market guidance, market expectation on the end of year cash balance. This is not because we've been underinvesting in areas, far from it. We're continuing to upskill the business with people and skills, and we're really making the business fit for purpose for the years ahead as we look to grow the business. And we're still a buy and build strategy, and allow us to easily integrate any of these acquisitions into the group itself. Significantly too, we're on track to meet market expectations on revenue. We've already talked about the 4.6 million of revenue that we're declaring for the 6-month period, but we have 6.8 million of contracted revenue, which over the fullness of time, because of revenue recognition rules, we will recognise over the next 6 months. So we've already got in the bag, or as a revenue bank, as it were, 11.4 million of revenue. This is against the market expectation of 12 million for the full year. So you can see we're over 90% of that revenue has been covered already, and so we're in a really good position to close out the remainder of FY22. We talked about the DWP contract, and there's a small amount of revenue relating to the DWP contract that's been factored into that 6.8 million. It's 150k, and I'll just briefly move on to talk about the DWP contract, so we'll get a little more colour on that. It's an initial 2-year term with an option to extend for a further 2 12-month periods. It's ARR value of up to 1.3 million. The charging model is based on a number of monthly active users. Now, these monthly active users will grow up over a period of time to get up to the 1.3 million ARR level, but we've got a minimum guarantee in year 1 and subsequent years of the contract of 1,700 monthly active users, which equates to just under 500,000 of guaranteed ARR. So for the 2 years of the contract, the initial 2 years of the contract term, we've got guaranteed ARR of 0.9 million, rising, if depending on utilisation, that will rise to 2.6 million for those 2 years. And if the option to extend is exercised for the further 2 years, then it can go up to 5.2 million of ARR over that 4-year period. Margin for the contract is in line with the existing AA contract, so typical sort of SaaS level GP margins of anywhere between 85 to 90% gross profit margin. And as mentioned before, there's a small amount of revenue that will accrue into FY22, and the remainder will go into growth forecasts for FY23. These are already baked into the forecasts that we've put out into the market today. But again, it's all part of our strategy and our growth going forward. And as we said before, this is a really exciting prospect for us because it allows us to go into other markets. Just briefly move on. Just moving very quickly to the income statement. I think what I'd like to just do, we talked about adjusted EBITDA, and really to kind of focus everyone's attention on the right-hand box there, just to show how we get from the period loss to the actual adjusted EBITDA number that we're talking about. Within the period, there's been a number of things, big non-cash movements, and also some one-off costs as well that we're calling exceptional items that relate to the acquisition primarily, and the fundraising that took part in June. So you can see we start with our loss after tax for the period of 6 million, and we add back depreciation, amortization, some non-cash movements and taxation to get to what would normally be an EBITDA. We're calling it an EBITDA in this instance of 4 million. And we're also then adding back some a non-cash item, being a fair value adjustment regarding the acquisition, and also we have some exceptional items of 1.6 million. So we take all those into consideration, we're getting back to our 0.7 million adjusted EBITDA number that we're talking about. And we'll be using this calculation as well as we project forward and look at the year end, and that's how we're getting to our break-even position on that. Very quickly move to the balance sheet. The balance sheet itself, I guess the one big thing sticking out there is in the comparative numbers compared to where we were at the year end, there's been significant movements across some of the accounts, primarily relating to the fundraise and to the acquisition as well. As we mentioned before, we've got 12.8 million on the balance sheet as we close out the period, and another figure that sticks out there is 1.7 million of trade and other receivables. But as you can see, as your revenue number goes up, then your trade receivables are going up as well, and there's no undue concern about that number getting bigger. It's credit control is well within the sort of normal accepted limits, so we've got no concerns there at all. So as I say, we close the period in a very good position, and James, I'll pass back to you to summarise.
Cool. Thank you very much, Guy. So, in summary, our company is on a really exciting trajectory, and we think we've got a really compelling investment case. I just want to talk about it briefly now. So if we think about our position within the UK market, we think it's strong and it's defendable. Attend Anywhere is the dominant market leader for video consultations in hospital across the British Isles, not just England, but Scotland, Wales, and the Republic of Ireland. We're confident in our outlook for renewal of those important Attend Anywhere contracts in England next March. We expect to renew the vast majority of hospitals. Now, we do expect some downward price pressure, but in part, this is because we're pushing for longer contract terms, which we think is really important for the business. Our recent win with the Department of Work and Pensions is an important milestone as we look to diversify our revenue beyond the NHS. It's a really key goal for us, and we see further opportunities in non-health public sector. We're well positioned to capitalise on the emerging formation of integrated care systems within NHS England, especially as central funding is now available to support the reduction of waiting lists. In fact, I've been operating in the NHS for 6-7 years now as a supplier to it, and I have never seen the degree of centralised funding for technology that we're seeing at the moment. And finally, we have valuable partnerships in place with key health system suppliers like Cerner and System C, and we expect to continue our momentum and form more partnerships, important partnerships, both here and overseas in the next 12 to 24 months. If we think about the financial fundamentals of the business, as Guy alluded to, we currently have 11.4 million of contracted revenue for this financial year, which is over 90% towards market expectations of just over 12 million for the full year. So we're really confident of hitting that revenue expectation by the end of the year. We're working hard to increase contract terms for Attend Anywhere in England, and we're confident that several English contracts will be renewed with at least a 2-year term, if not longer. We're ahead of market expectations on adjusted EBITDA for the full year, projecting a break-even position, and this gives us further confidence we'll achieve that goal that we've set ourselves to be cash break-even by the end of FY23 next financial year. Beyond the NHS, we see further opportunities in non-health public sector, reinforced by our recent win with DWP. And finally, it's absolutely our plan to continue our buy and build journey, and we're really focused on finding accretive acquisitions next year that will take us into new territories, again, growing the multiple that the business will be valued at and further diversifying our revenue base. So hopefully that was helpful to everybody listening, and once again, thank you. I think we're happy, that concludes the presentation. Mark, we're happy to go into Q&A now.
That's great. James, Guy, thank you for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while Guy and James take a few moments to review the investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that your feedback is as important to the company, and immediately after this presentation has ended, we'll redirect you for the opportunity to provide feedback in order that the company can better understand your views and expectations. Guy, James, that's not an awful long while to have read through the questions. I don't know whether or not you want to bring the cameras back up, but the questions are on the right-hand side in the Q&A tab. If I could please hand back to you and ask you to read the questions and give a response where it's appropriate to do so. Thank you.
Yeah, will do. Camera back on. Thank you, Guy.
There you go.
Hello, everybody.
Hold on, I'll just quickly go to the first one here.
Yeah.
Did I read correctly that over 90% of your revenues are already booked for this year, and the revenues are in excess of 12 million? What percentage of UK hospitals use induction products?
Yes, there's a couple of questions there. So current contracted revenues are 11.4 million. and market expectation is around 12 million. So yes, over 90% of the market expectation number for the full year is contracted, which gives us a lot of confidence that we're going to meet expectations for this year, which is obviously very important. And then what percentage of UK hospitals use induction products? Well, 100%, because Attend Anywhere is used across all of the outlying territories in the British Isles, not including England. It's almost got 100% coverage in England. Switch, of course, is used at 100% of hospitals in England. Guidance is used at over half the hospitals in England, etc. So if you look at our entire product range, we cover every hospital pretty much in the British Isles now, I think.
And just to go back on that first point, 90% of the revenue is already booked for the year. 4.6 million we've booked in the first 6 months. We already have contracted another 6.8 million that just over revenue recognition rules will be recognised. It's there, it's in the bag, and just to make that clear. To that question then.
Okay.
I'll read this one out to you. Switch has done well to establish a strong following and usage amongst medical professionals. How do INHC intend to take advantage of this market position in terms of monetising Switch over the next 2 to 3 years?
So it's a really good question. And as I alluded to in the core of the presentation, we have candidly struggled to monetize during the pandemic, but we're now absolutely seeing, engagement levels we just weren't getting 6 to 9 months ago. Our monetization strategy for Switch really has 2 phases to it. Phase 1 is we want to monetize it between 5,000 and 10,000 a year for as many hospitals as we can, and there's potential, obviously, to monetize all of them because it's a very, very widely used product. That will create a strong, stable base of recurring revenue. And then selectively, we've got a number of value-added features on the Switch platform that we'll begin to sell into key hospitals to increase that ARR. So that's the direct monetization of Switch. However, as a management team, we believe that engaged user base is incredibly valuable. And there are a number of things, we're not quite ready to kind of reveal them in public yet, but there are a number of things we're looking to do to leverage and engage that user base through the context of our integrated flexible care platform. Now, internally, we're very excited about that, and watch this space is what I would say on Switch.
Good. The next one, is there anything substantially different between your offering and Teladoc in doctor patient, am I reading that right? And Teladoc in doctor patient consultation? If not, then why are they valued at 15 times revenue and you at 2.5 times? Yeah,
I mean, I think that there's quite a lot to unpack in this question. So if you just look at the ability to run a remote consultation, so video, telephone, then there's very little that differentiates the Teladoc offering from Attend Anywhere. I'd argue that probably Attend Anywhere has a slightly more mature model that's in kilter with the way UK and European healthcare works in terms of running video-based consultations at scale. It's another key point when we think about the difference between Teladoc and particularly Attend Anywhere is we don't employ any doctors. We present a high margin, we are a software-only business, and we're very focused on that SaaS software revenue line, whereas I believe Teladoc, part of their offering is they also deliver the care. And in terms of the difference in multiples, which I think is really what this question is about, we are absolutely seeing very high multiples for US-based digital health products. And I think it speaks to the fact, candidly, that I think the multiple that we currently have based on our current share price, undervalues Induction quite substantially. Hopefully that's not too much of a contentious statement, but that's certainly what I believe.
Okay, next one up, we've got Michael D. Giving us a little bit of a pat on the back. Michael D saying, well done with the significant progress.
Thank you, Michael.
Thank you, Michael. You mentioned acquisitions. What's your thoughts here?
So, I think candidly, we need to remain opportunistic in order to conduct M&A effectively. We're not going to completely rule out acquiring, another domestic business that reinforces our vision of this flexible care platform. But the heart of our M&A strategy is to identify accretive targets who've got proven product market fit in territories outside the UK. We see M&A as the key route to new markets to get to grow our revenue line and our territory base inorganically quickly.
Okay. Tom B, does INHC have have a strategy to set up communications with existing shareholders and marketing to prospective investors?
Yeah, I mean, it's something we do need to be better at, to be honest, Tom. And we're working, hard now on engaging, particularly with our retail shareholders. We're going to set up things like, email newsletters where we're allowed to and get more proactive in terms of publishing news and that stuff. We're working, hand in hand with our communications agency to get more engaged, to get more press, more coverage. We don't think the story's written about enough. We think Induction's a really exciting business, and we're just not getting out there and telling our story to enough people. And that's something we're going to be really focused on in the coming months.
James, Guy, maybe I can interrupt here. Thank you for taking those live questions from investors, and kind of the reverse way around. But obviously, we did receive a number of pre-submitted questions, and wondered if I could maybe throw some of those at you guys for your thoughts. The first question we received is: in your view, was 25.4 million price for Attend Anywhere represent a good value, or was it highly priced?
Yeah, so I mean, I think on balance, knowing what we know now, I think it represents excellent value. I mean, I think we've paid 2.5 times recurring revenues, which I think is a very good price. But I think when we acquired Attend Anywhere, we did it safely. Well, I don't know about safely. Sorry, we did it in the knowledge that we were facing some structural risk. So at the point of acquisition, the central funding status for video consulting in England, our biggest contract, was unclear. We knew that we only had 1 year left to run on the vast majority of AA's revenue. So the risk, as we measured it at the time of acquisition, was higher than we believe it is now. So we're feeling much more confident about Attend Anywhere renewals in England, than we were at the point of acquisition. And I think that risk that we saw when we bought AA, obviously contributed to the price that we paid. But it's feeling like a very well priced acquisition for the company now. Yeah.
That's great. Thank you very much indeed. A question really up here about your expansion plans, and what are your plans to expand geographically? Can the current suite of software be used internationally, or would it need to be developed, or would you need to buy something new?
Yes, I think in order to effectively expand internationally, we are quite focused on making further acquisitions. But I think the value those acquisitions will deliver to the company and hence shareholders is that immediate footprint in the new territory, as opposed to potentially needing to acquire them to enhance our technology. And one of the reasons why we're very focused on the secondary care market and increasingly the community care market is that model is pretty much the same all over the world. So the way a hospital works here is pretty much the way a hospital works in America, is pretty much the way a hospital works in Germany. So that portability speaks to our technology platform, and we're fairly happy that our technology is we know it's super relevant in the domestic market, and we're fairly happy it's relevant and on point in other markets. And in terms of our plans for international expansion, we're working very hard to generate revenue in the Australian market, where obviously a sizable number of our team are based, so we already have boots on the ground there. We're really focused on delivering revenue from Australia during FY23. And then we will be pursuing, almost certainly an M&A strategy to enter other new markets. Personally, I'd like to see us make another sizable accretive acquisition next year that takes us into a third territory. I think that would continue the momentum for us.
That's brilliant. Thank you, James. When will we hear on the AA contract renewals in England? Will these be announced together in one block, or potentially as they come in?
Yeah, so it'll be as they come in. I think we can expect to hear. At the moment, it looks like the renewal contracting is going to run the same way as the contracts we closed in March this year. So there'll be approximately 8 regions across England will contract. We did have a fear that those regions might devolve into individual hospitals, which would obviously have made it harder for us, to renew a much larger volume of contracts. But it does now feel like it's going to remain with those 8 regions, which is good news. And as I alluded to before, we also know that there is central money available to help those regions pay the bill, which is, again, hugely helpful. I think there's the potential for us to hear early in the new year about a few of the regions. We are engaged with some of them, and they are keen to renew perhaps before the end of March. And then I think we're going to, we will close a number of them in February, and then there'll be a long tail of the balance of those contracts that, we run to the wire to March 31st. And I don't think that's specific to Attend Anywhere. In my experience, that's pretty normal for anything that gets procured by the NHS. So it's going to come in sort of drips and drabs between now and the end of March.
That's great. Thank you very much indeed. General question really about share price, talking about the placing price and then obviously the volatility around share price movements. But in short, do you think the shares are undervalued?
Yes, heavily so is my answer. And I think we obviously we raised quite a lot of money relative to our market cap to acquire Attend Anywhere. It's a challenging time of year for a business like Induction, where our single pay at the moment really is the NHS. Sort of late summer coming into kind of early autumn to now. Typically you don't tend to sign new business. You get very busy signing new business in the last quarter of the year, so January, February, March. Now, the reason that's important is because our ability to sign new contracts determines our ability to release news flow to the market. So I think we've been quieter than we would have liked to have been. We've obviously announced some really meaningful stuff recently, particularly with things like Department of Work and Pensions. We're super excited about the prospects for the company. But fundamentally, we think the market's really substantially undervaluing us. And a lot of the institutional investors that we're going to be talking to, that we have spoken to already, we're going to be talking to over the coming days. I think the consensus view is shared. That we are quite undervalued based on how we're performing.
That's great. Thank you very much indeed. If I may turn to the next question, can you explain the relationship with, or how the relationship with Cerner works? When did you first establish a relationship, and why did they choose you?
Yeah, so the relationship with Cerner is a formal value-added reseller agreement. So they resell our product, obviously, to their existing customers and some of their new customers. We signed that agreement in October last year, so it's been running for a little over a year. And the way it works is there's a couple of key points that are important to Induction. Firstly, all of the business that we're doing in partnership with Cerner tends to be written as a change in control. It's called a CCN contract under the existing contract they have with the hospital. And that's quite an important point to land, because it means that, quite legitimately, because you're extending an existing contract, the hospital doesn't have to run a competitive procurement, which is quite good in terms of our sort of time to closing a deal. And the reason they picked us is that they saw huge synergy between their patient portal product, which is called Healthy Life, which Cerner is an American company, so Healthy Life was built with an American market focus. It hadn't been localized for markets outside of the US, particularly the UK market. They saw a huge opportunity to put elements of their product into the Zesty product, which at the time was heavily in demand, and we're seeing that demand resurface now post the pandemic. So it made a lot of strategic sense for Cerner to go to market with the strongest product in the market, which at the time was us, and I would argue still is. So I think it made a lot of sense for them to really bolster the capability of their consumer-facing offering. And obviously it made a lot of sense for us because Cerner's got the ear of all of those customers. And it makes a huge difference to us if we go to a hospital selling our flexible care platform to have, Cerner, who provides the underlying hospital operating system, if you like, EPR, to have them in our corner helping us sell is hugely, hugely helpful. And we're very, very positive and confident about the pipeline we're now seeing, with Cerner for Zesty and increasingly Attend Anywhere enhancements in the UK market moving forwards.
That's very kind. Thank you, James. We've got a couple of final questions. The first one is as follows. How long is the tender process for annual contracts?
Sorry, Mark, I missed that. Say that one again.
Sorry, how long is the tender process for annual contracts?
Right, yeah. So the answer to that question wildly varies. It can be very quick. When you have central money involved, sometimes deadlines are set where the money has to be spent by a certain time. So we've seen certain things get contracted in a number of weeks, and equally it can take quite a long time to get the contracting arrangements sorted out. We did a meaningful piece of work, a meaningful contract for Induction in Southwest London in partnership with Cerner, and it took really quite a long time, several months, to get the contracting framework sorted out there. The good news with things like that is once you've done it once, it then becomes repeatable to do again. So there is no straight answer to that question. It heavily depends on the dynamics of a particular deal.
That's perfect. And if I may turn to the final pre-submitted question, which reads as follows: the NHS is a notoriously difficult beast to extract cash from, perhaps reflected in the 1.7 million of trade receivables in these results. How do you plan to keep that in track?
I don't think, not to be contentious, but I don't think I agree with the premise of the question. So I think there's a couple of things to unpack here. I think the first is that it is notoriously difficult to win new business with the NHS. So imagine you're going out and you are selling, a new service or product to the NHS that they haven't seen or used before. That's hard yards. That takes time and it's difficult. And we see a lot of, smaller digital health companies who really fight for years and years and years to get their first 2, 3, 4, 5, 6 hospital deals. I think it becomes a different proposition when you kind of are the incumbent and you're looking to cross-sell or upsell products where they are an existing customer. So in terms of that sort of looking at the lens of winning new business, I think particularly Induction's in a really good position because we have such a wide existing contracting base. And then for the more mechanical point of the question, which is, how long does it take the NHS to pay? The NHS actually historically are very good payers, and they can be in certain circumstances penalised for taking too long, like all government bodies, for taking too long to pay small suppliers. What can take some time with the NHS sometimes is the mechanics of getting a purchase order. But again, I think that's about running an efficient team on our side and being good at chasing those things down.
Yeah, Mark, can I just add to that as well? And when we look at the balances, I think we had 800,000 in the prior periods outstanding, about 1.6, 1.7 million. None of those are out with terms. And actually, when you look at the revenue as well, our revenue's gone up by 700,000, right? So it's natural that trade receivables figure is going to be slightly bigger as well. And even if you take a crude measure, I know our invoicing profile isn't flat, right? But if you're to take 12 million revenue, divide by 12, add on a bit of VAT, you're 1.2 million. It only needs to be like a 45-day payment term, and you're already up at that 1.7 million balance. So, we're as a finance team within the business, we're right on top of that because cash is key for us just now. But I don't envisage. Even that 1.7 million now, if you move on to where we're sitting at today, the majority of that's been collected, if not all. So there's nothing sitting for us as an executive team as flagging.
Nothing sinister.
No, there's nothing there that's flagging us as any sort of issue at all. So we're still confident, but we'll keep right on top of it as part of what we do day in, day out.
That's brilliant. Thank you very much indeed. As I say, that takes care of all the pre-submitted questions. I don't know if you just want to have a quick scan to see if there's anything further that's come in that may be of interest to you.
Yeah, we've got a question from Tom.
Do you want me to read it out?
Yeah, go on.
Tom B, I think most existing shareholders will agree with you that INHC is undervalued at the moment. Putting you on the spot, which we like to do. Where do you think INHC's market cap should be right now?
Yeah, good question. So I think I think there's a number of ways you can skin this particular cat, for want of a better analogy. And I also think I'm cognizant of the fact that most CEOs and CFOs think their businesses are undervalued, right? But then having said that, I really do genuinely believe Induction's undervalued. So I think mechanically, I think it's fair to value a business like Induction on sort of guidance that's out in the market, and how far out that goes. So we have guidance in the market, or market expectations are around 17 million in revenue for the end of FY23. If you take a multiple on that, I don't think 8 times for a company that's growing like we are, that's in our sector, is unreasonable. So I think that puts our market cap, north of 100 million, would be my view on answering that question.
Yeah.
Hopefully I didn't get into trouble by giving that answer.
No. I think it's multiples are determining all manner of different things, right? And so I don't think that's unfair.
That's perfect.
But I also think, sorry, Mark, because I think it's a really fair question. I also think that it's incumbent on us as a management team to do what we say we're going to do. And I think the market will get more confidence in us as a relatively new team, but be a relatively new business to the market when we hit those numbers. We say we're going to do things, and we do the things that we say we're going to do. And I think we've had a really good 6 months. We're going to have a really good year end. We're coming to interims in FY23. That'll be 3, hopefully, consecutive quarters of really good performance where we've met market expectations. And I think the market will then start to trust us more. And so I think it's it's easy for people like us to sit here and whine that our share price is too low, but I also think there's work we have to do as a management team to really engage with our investors, both institutional and retail, and to keep our promises.
Well, that's great. Thank you very much indeed. I know investor feedback is important, so I think you've taken all the questions. So before I perhaps redirect investors to give you their thoughts and expectations, and I guess without asking you to repeat yourself, but if I could ask you just for a few closing comments to wrap up with, that'd be fantastic. And I'll, as I say, redirect investors.
Yeah, no, thank you, Mark. So just reiterate my opening comment. Thank you very much for everybody who's come and taken time out to listen to us. We really appreciate it. And I think I'd sum it up quickly by saying, we've genuinely had a really transformational 6 months. We've seen a step change in all of the key financial metrics. We're really excited about the next 6 months. We're really excited about FY23. We think that there are really significant kind of structural drivers in the market, both here and overseas, driving companies that operate in our space forwards. We think our strategy of working alongside existing providers, not delivering the care ourselves, but operating as a higher margin SaaS platform is absolutely the right one. And we are very excited to be doing what we're doing in the space that we're doing it in, and we hope that all of our shareholders will stay with us for the journey and benefit like we will. Thank you.
That's great, James. Guy, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued and welcomed by the company. On behalf of the management team of Induction Healthcare Group PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, so thank you once again and good afternoon.